The adage, time is money. It seems like this adage about time is highly relevant when it comes to options trading. Forget all the Greek talk for now. We shall go back to understand one basic concept concerning time. Assume you have enrolled for a competitive exam. You are inherently a bright candidate and have the capability to clear the exam. However, if you do not give it sufficient time and brush up the concepts, you are likely to flunk the exam. So given this, what is the likelihood that you will pass this exam? Well, it depends on how much time you spend to prepare for the exam, right? Let's keep this in perspective and figure out the likelihood of passing the exam against the time spent preparing for the exam. Number of days for preparation. Likelihood of passing: 30 days very high, 20 days high, 15 days moderate, 10 days low, 5 days very low, 1 day ultra low. Quite obviously, higher the number of days for preparation, the higher is the likelihood of passing the exam. Keeping the same logic in mind, think about the following situation. Nifty spot is 8,500. You buy a nifty 8,700 call option. What is the likelihood of this call option to expire in the money ITM? Let me rephrase this question in the following way. Given Nifty is at 8,500 today, what is the likelihood of Nifty moving 200 points over the next 30 days and therefore 8,700 CE? Expiring ITM. The chance for Nifty to move 200 points over next 30 days is quite high. Hence, the likelihood of option expiring ITM upon expiry is very high. What if there are only 15 days to expiry? An expectation that Nifty will move 200 points over the next 15 days is reasonable. Hence, the likelihood of option expiring ITM upon expiry is high. Notice it is not very high, but just high. What if there are only 5 days to expiry? Well, 5 days, 200 points. Not really sure, hence the likelihood of 8,700 CE expiring in the money is low. What if there was only 1 day to expiry? The probability of Nifty to move 200 points in 1 day is quite low. Hence, I would be reasonably certain that the option will not expire in the money. Therefore, the chance is ultra low. Is there anything that we can infer from the above? Clearly, the more time for expiry, the likelihood for the option to expire in the money ITM is higher. Now keep this point in the back of your mind as we now shift our focus on the option seller. We know an option seller sells, writes an option and receives the premium for it. When he sells an option, he is very well aware that he carries an unlimited risk and limited reward potential. The reward is limited to the extent of the premium he receives. He gets to keep his reward premium fully only if the option expires worthless. Now, think about this. If he is selling an option early in the month, he very clearly knows the following. He knows he carries unlimited risk and limited reward potential. He also knows that by virtue of time, there is a chance for the option he is selling to transition into ITM option, which means he will not get to retain his reward premium received. In fact, at any given point, thanks to time, there is always a chance for the option to expiry in the money, although this chance gets lower and lower as time progresses towards the expiry date. Given this, an option seller would not want to sell options at all, right? After all, why would you want to sell options when you very well know that simply because of time? There is scope for the option you are selling to expire in the money. Clearly, time in the option seller's context acts as a risk. Now, what if the option buyer, in order to entice the option seller to sell options, offers to compensate for the time risk that the option seller assumes? In such a case, it probably makes sense to evaluate the time risk versus the compensation and take a call, right? In fact, this is what happens in real-world options trading. Whenever you pay a premium for options, you are indeed paying towards time risk, intrinsic value of options. In other words, premium equals time value plus intrinsic value. Recall earlier in this module we defined intrinsic value as the money you are to receive if you were to exercise your option today. Just to refresh your memory, Let us calculate the intrinsic value for the following options assuming Nifty is at 8,423. 8350 CE. 8450 CE. 8,400 pay. 8,450 pay. We know the intrinsic value is always a positive value or zero and can never be below zero. If the value turns out to be negative, then the intrinsic value is considered zero. We know for call options the intrinsic value is spot price, strike price, and for put options it is strike price, spot price. Hence the intrinsic values for the above options are as follows. 8350 CE equals 8423, 8350 equals plus 73. 8450 CE equals 8423, 8450 equals V value hence 0. 8,400 pay equals 8400, 8423 equals V value hence 0. 8,450 pay equals 8450, 8423 equals plus 27. So given that we know how to calculate the intrinsic value of an option, let us attempt to decompose the premium and extract the time value and intrinsic value. Have a look at the following snapshot. Details to note are as follows. Spot value equals 8,531. Strike equals 8,600 CE. Status equals OTM. Premium equals 99.4. Today's date equals the 6th of July 2015. Expiry equals the 30th of July 2015. Intrinsic value of a call option, spot price, strike price i.e. 8531, 8600 equals 0, since it's a negative value. We know premium equals time value plus intrinsic value 99.4 equals time value plus 0. This implies time value equals 99.4. Do you see that? The market is willing to pay a premium of 99 rupees and 40 paise per for an option that has zero intrinsic value but ample time value. Recall time is money smiley face. Here is snapshot of the same contract that I took the next day, i.e. the 7th of July. Notice the underlying value has gone up slightly, 8,538, but the option premium has decreased quite a bit. Let's decompose the premium into its intrinsic value and time value, spot price, strike price. i.e. 8538, 8600 equals 0. Since it's a negative value, we know premium equals time value plus intrinsic value 87.9 equals time value plus 0. This implies time value equals 87.9. Notice the overnight drop in premium value. We will soon understand why this happened. Note, in this example, the drop in premium value is 99.4 minus 87.9 equals 11.5. This drop is attributable to drop in volatility in time. We will talk about volatility in the next chapter. For the sake of argument, if both volatility and spot were constant, the drop in premium would be completely attributable to the passage of time. I would suspect this drop would be around 5 rupees or so and not really 11 rupees and 50 paise per. Let us take another example. Spot value equals 8,514.5. Strike equals 8450 CE. Status equals ITM. Premium equals 160. Today's date equals the 7th of July 2015. Expiry equals the 30th of July 2015. Intrinsic value of call option, spot price, strike price i.e. 8,514.5, 8,450 equals 64.5. We know premium equals time value plus intrinsic value 160 equals time value plus 64.5. This implies the time value equals 160. 64.5 equals 95.5. Hence out of the total premium of 160 rupees, traders are paying 64.5 towards intrinsic value and 95.5 towards the time value. You can repeat the calculation for all options, both calls and puts, and decompose the premium into the time value and intrinsic value. 14.2 Movement of time. Time, as we know, moves in one direction. Keep the expiry date as the target time and think about the movement of time. Quite obviously, as time progresses, the number of days for expiry gets lesser and lesser. Given this, let me ask you this question. With roughly 18 trading days to expiry, traders are willing to pay as much as 100 rupees per towards time value. Will they do the same if time to expiry was just 5 days? Obviously, they would not, right? With lesser time to expiry, traders will pay a much lesser value towards time. In fact, here is a snapshot that I took from the earlier months. Date equals the 29th of April. Expiry date equals the 30th of April. Time to expiry equals 1 day. Strike equals 190. Spot equals 179.6. Premium equals 30 paisa. Intrinsic value equals 179.6 to 190 equals 0 since it's a negative value. Hence time value should be 30 paisa, which equals the premium. With 1 day to expiry, traders are willing to pay a time value of just 30 paisa. However, if the time to expiry was 20 days or more, the time value would probably be 5 rupees or 8 rupees per. The point that I'm trying to make here is this: with every passing day, as we get closer to the expiry day, the time to expiry becomes lesser and lesser. This means the option buyers will pay lesser and lesser towards time value. So if the option buyer pays 10 rupees as the time value today, tomorrow he would probably pay 9 rupees and 50 paise per as the time value. This leads us to a very important conclusion: all other things being equal, an option is a depreciating asset. The option's premium erodes daily, and this is attributable to the passage of time. Now the next logical question is, by how much would the premium decrease on a daily basis owing to the passage of time? Well, theta, the third option Greek, helps us answer this question. 14.3 theta. All options, both calls and puts, lose value as the expiration approaches. The theta or time decay factor is the rate at which an option loses value as time passes. Theta is expressed in points lost per day when all other conditions remain the same. Time runs in one direction. Hence theta is always a positive number. However, to remind traders it's a loss in options value, it is sometimes written as a negative number. A theta of minus 0.5 indicates that the option premium will lose minus 0.5 points for every day that passes by. For example, if an option is trading at 2 rupees and 75 paise per with theta of minus 0.05, then it will trade at 2 rupees and 70 paise per the following day, provided other things are kept constant. A long option buyer will always have a negative theta, meaning all else equal, the option buyer will lose money on a day-by-day basis. A short option seller will have a positive theta. Theta is a friendly Greek to the option seller. Remember, the objective of the option seller is to retain the premium. Given that options loses value on a daily basis, the option seller can benefit by retaining the premium to the extent it loses value owing to time. For example, if an option writer has sold options at 54 rupees, with theta of 0.75, all else equal, the same option is likely to trade at equals 0.75 asterisk 3 equals 2.25 equals 54 to 2.25 equals 51.75. Hence the seller can choose to close the option position on T plus 3 day by buying it back at 51 rupees and 75 paise per and profiting 2 rupees and 25 paise. And this is attributable to theta. Have a look at the graph below. This is the graph of how premium erodes as time to expiry approaches. This is also called the time decay graph. We can observe the following from the graph. At the start of the series, when there are many days for expiry, the option does not lose much value. For example, when there were 120 days to expiry, the option was trading at 350. However, when there was 100 days to expiry, the option was trading at 300. Hence the effective theta is low. As we approach the expiry of the series, the effective theta is high. Notice when there was 20 days to expiry, the option was trading around 150. But when we approach towards expiry, the drop in premium seems to accelerate. Option value drops below 50. So if you are selling options at the start of the series, you have the advantage of pocketing a large premium value, as the time value is very high, but do remember the fall in premium happens at a low rate. You can sell options closer to the expiry, you will get a lower premium, but the drop in premium is high, which is advantageous to the options seller. Theta is a relatively straightforward and easy Greek to understand. We will revisit theta again when we will discuss cross-dependencies of Greeks. But for now, if you have understood all that's being discussed here, you are good to go. We shall now move forward to understand the last and the most interesting Greek, vega. Key takeaways from this chapter. Option sellers are always compensated for the time risk. Premium equals intrinsic value plus time value. All else equal, options lose money on a daily basis owing to theta. Time moves in a single direction, hence theta is a positive number. Theta is a friendly Greek to option sellers. When you short naked options at the start of the series, you can pocket a large time value, but the fall in premium owing to time is low. When you short option close to expiry, the premium is low thanks to time value, but the fall in premium is rapid. 93 responses to theta. Panki T. Shaw. July 9th. Open a ZERODHA account. Chapter 15. Volatility Basics. Hindi Gujarati. 15.1 Background. Having understood delta, gamma, and theta, we are now at all set to explore one of the most interesting option Greeks, the vega. Vega, as most of you might have guessed, is the rate of change of option premium with respect to change in volatility. But the question is, what is volatility? I have asked this question to quite a few traders, and the most common answer is volatility is the up-down movement of the stock market. If you have a similar opinion on volatility, then it is about time we fixed that smiley face. So here is the agenda. I suppose this topic will spill over a few chapters. We will understand what volatility really means, understand how to measure volatility, practical application of volatility, understand different types of volatility, understand vega. So let's get started. 15.2 Moneyball. Have you watched this Hollywood movie called Moneyball? It's a real-life story. Billy Beane, manager of a baseball team in U.S. The movie is about Billy Beane and his young colleague, and how they leverage the power of statistics to identify relatively low-profile but extremely talented baseball players. A method that was unheard of during his time, and a method that proved to be both innovative and disruptive. You can watch the trailer of Moneyball here. I love this movie, not just for Brad Pitt, but for the message it drives across on topics related to life and business. I will not get into the details now. However, let me draw some inspiration from the Moneyball method to help explain volatility. Smiley face. The discussion below may appear unrelated to stock markets, but please don't get discouraged. I can assure you that it is relevant and helps you relate better to the term volatility. Consider two batsmen and the number of runs they have scored over 6 consecutive matches. Match Billy Mike. 1-2-0-4-5. 2-2-3-1-3. 3-2-1-1-8. 4-2-4-1-2. 5-1-9-2-6. 6-2-3-1-9. You are the captain of the team, and you need to choose either Billy or Mike for the 7th match. The batsman should be dependable, in the sense that the batsman you choose should be in a position to score at least 20 runs. Whom would you choose? From my experience, I have noticed that people approach this problem in one of the two ways. Calculate the total score, also called sigma, of both the batsmen. Pick the batsman with the highest score for next game. Or calculate the average, also called mean, number of scores per game. Pick the batsman with better average. Let us calculate the same and see what numbers we get. Billy's sigma equals 20 plus 23 plus 21 plus 24 plus 19 plus 23 equals 130. Mike's sigma equals 45 plus 13 plus 18 plus 12 plus 26 plus 19 equals 133. So based on the sigma, you are likely to select Mike. Let us calculate the mean or average for both the players and figure out who stands better. Billy equals 136 equals 21.67. Mike equals 133 sixths equals 22.16. So it seems from both the mean and sigma perspective, Mike deserves to be selected. But let us not conclude that yet. Remember, the idea is to select a player who can score at least 20 runs, and with the information that we have now, mean and sigma, there is no way we can conclude who can score at least 20 runs. Therefore, let's do some further investigation. To begin with, for each match played, we will calculate the deviation from the mean. For example, we know Billy's mean is 21.67, and in his first match, Billy scored 20 runs. Therefore, deviation from mean form the first match is 20 to 21.67 equals 1.67. In other words, he scored 1.67 runs lesser than his average score. For the second match, it was 23 to 21.67 equals plus 1.33. Meaning he scored 1.33 runs more than his average score. Here is the diagram representing the same for Billy. The middle black line represents the average score of Billy, and the double-arrowed vertical line represents the deviation from mean for each of the match played. We will now go ahead and calculate another variable called variance. Variance is simply the sum of the squares of the deviation divided by the total number of observations. This may sound scary, but it's not. We know the total number of observations in this case happens to be equivalent to the total number of matches played, hence 6. So variance can be calculated as variance equals minus 1.67 squared plus 1.33 squared plus minus 0.67 squared plus 2.33 squared plus minus 2.67 squared plus 1.33 squared 6. Equals 19.336 equals 3.22. Further, we will define another variable called standard deviation, SD, which is calculated as STD deviation equals square root variance. So standard deviation for Billy is equals SQRT 3.22 equals 1.79. Likewise, Mike's standard deviation works out to be 11.18. Let's stack up all the numbers, or statistics, here. Statistics Billy Mike. Sigma 130,133. Mean 21.6, 22.16. SD 1.79, 11.18. We know what mean and sigma signifies. But what about the SD? Standard deviation simply generalizes and represents the deviation from the average. Here is the textbook definition of SD in statistics. The standard deviation, SD, also represented by the Greek letter sigma. Sigma is a measure that is used to quantify the amount of variation or dispersion of a set of data values. Please don't get confused between the two sigmas. The total is also called sigma, represented by the Greek symbol, and standard deviation is also sometimes referred to as sigma, represented by the Greek symbol sigma. One way to use SD is to make a projection on how many runs Billy and Mike are likely to score in the next match. To get this projected score, you simply need to add and subtract the SD from their average. Player lower estimate, upper estimate. Billy 21.6 to 1.79 equals 19.81. 21.6 plus 1.79 equals 23.39. Mike 22.16 to 11.18 equals 10.98. 22.16 plus 11.18 equals 33.34. These numbers suggest that in the upcoming 7th match, Billy is likely to get a score anywhere in between 19.81 and 23.39, while Mike stands to score anywhere between 10.98 and 33.34. Because Mike has a wide range, it is difficult to figure out if he is going to score at least 20 runs. He can either score 10 or 34 or anything in between. However, Billy seems to be more consistent. His range is smaller, which means he will neither be a big hitter nor a lousy player. He is expected to be a consistent and is likely to score anywhere between 19 and 23. In other words, selecting Mike over Billy for the 7th match can be risky. Going back to our original question, which player do you think is more likely to score at least 20 runs? By now, the answer must be clear. It has to be Billy. Billy is consistent and less risky compared to Mike. So in principle, we assess the riskiness of these players by using standard deviation. Hence, standard deviation must represent risk in the stock market world. We define volatility as the riskiness of the stock or an index. Volatility is a percent number as measured by standard deviation. I've picked the definition of volatility from Investopedia for you, a statistical measure of the dispersion of returns for a given security or market index. Volatility can either be measured by using the standard deviation or variance between returns from that same security or market index. Commonly higher the standard deviation, higher is the risk. Going by the above definition, if Infosys and TCS have volatility of 25% and 45% respectively, then clearly Infosys has less risky price movements when compared to TCS. 15.3 Some food for thought. Before I wrap this chapter, let's do some prediction. Today's date equals the 15th of July 2015. Nifty spot equals 8,547. Nifty volatility equals 16.5%. TCS spot equals 2,585. TCS volatility equals 27%. Given this information, can you predict the likely range within which Nifty and TCS will trade 1 year from now? Of course we can. Let us put the numbers to good use. Asset lower estimate, upper estimate. Nifty 8,547, 16.5% asterisk 8,547 equals 71368547 plus 16.5% asterisk 8,547 equals 9,009. So the above calculations suggest that in the next 1 year, Given Nifty's volatility, Nifty is likely to trade anywhere between 7,136 and 9,957, with all values in between having varying probability of occurrence. This means to say on the 15th of July 2016 the probability of Nifty to be around 7,500 could be 25%, while 8,600 could be around 40%. This leads us to a very interesting platform. We estimated the range for Nifty for 1 year. Similarly, can we estimate the range Nifty is likely to trade over the next few days, or the range within which Nifty is likely to trade up to the series expiry? If we can do this, then we will be in a better position to identify options that are likely to expire worthless, meaning we could sell them today and pocket the premiums. We figured the range in which Nifty is likely to trade in the next 1 year is 7,136 and 9,957, but how sure are we? Is there any degree of confidence while expressing this range? How do we calculate volatility? I know we discussed the same earlier in the chapter, but is there an easier way? Hint, we could use MS Excel. We calculated Nifty's range estimating its volatility is 16.5%. What if the volatility changes? Over the next few chapters we will answer all these questions and more. Key takeaways from this chapter. Vega measures the rate of change of premium with respect to change in volatility. Volatility is not just the up-down movement of markets. Volatility is a measure of risk. Volatility is estimated by standard deviation. Standard deviation is the square root of variance. We can estimate the range of the stock price given its volatility. Larger the range of a stock, higher is its volatility, aka risk. Open a ZERODHA account. Chapter 16. Volatility Calculation Historical. Hindi Gujarati. 16.1 Calculating Volatility on Excel. In the previous chapter, we introduced the concept of standard deviation and how it can be used to evaluate risk or volatility of a stock. Before we move any further on this topic, I would like to discuss how one can calculate volatility. Volatility data is not easily available. Hence, it's always good to know how to calculate the same yourself. Of course, in the previous chapter we looked into this calculation. Recall the Billy and Mike example. We outlined the steps as follows. Calculate the average. Calculate the deviation, subtract the average from the actual observation. Square and add up all deviations, this is called variance. Calculate the square root of variance, this is called standard deviation. The purpose of doing this in the previous chapter was to show you the mechanics behind the standard deviation calculation. In my opinion, it is important to know what really goes beyond a formula. It only enhances your insights. In this chapter, however, we will figure out an easier way to calculate standard deviation or the volatility of a given stock. Using MS Excel. MS Excel uses the exact same steps we outlined above, just that it happens at a click of a button. I'll give you the border steps involved first and then elaborate on each step. Download the historical data of closing prices. Calculate the daily returns. Use the STDEV function. So let us get to work straight away. Step 1. Download the historical closing prices. You can do this from any data source that you have. Some of the free and reliable data sources are NSE India website and Yahoo Finance. I will take the data from NSE India for now. At this point, I must tell you that NSE's website is quite resourceful. And in terms of information provided, I guess NSE's website is one of the best stock exchange websites in the world. Anyway, in this chapter, let us calculate Wipro's volatility. To download the historical closing prices, visit http://www.nsindia.com/products/content/equities/equities/equities.htm and click on Historical Data and select the search option. Here is a snapshot where I have highlighted the search option. Once you hit search, a set of fields open up. Filling them up is quite self-explanatory, just fill in the required details and hit Get Data. Do make sure you get the data for the last 1 year. The dates that I have selected here is from the 22nd of July 2014 to the 21st of July 2015. Once you hit Get Data, NSE's website will query your request and fetch you the required data. At this point, you should see the following screen. Once you get this, click on Download File in CSV format highlighted in the green box. And that's it. You now have the required data on Excel. Of course, along with the closing prices, you have tons of other information as well. I usually like to delete all the other unwanted data and stick to just the date and closing price. This makes the sheet look clutter-free and crisp. Here is a snapshot of how my Excel sheet looks at this stage. To note, I have deleted all the unnecessary information. I have retained just the date and closing prices. Step 2. Calculate daily returns. We know that the daily returns can be calculated as return equals ending price, beginning price, 1. However, for all practical purposes and ease of calculation, this equation can be approximated to return equals lane, ending price, beginning price, where lane denotes logarithm to base e. Note this is also called log returns. Here is a snapshot showing you how I've calculated the daily log returns of Wipro. I have used the Excel function, lane, to calculate the log returns. Step 3. Use the STDEV function. Once the daily returns are calculated, you can use an Excel function called STDEV to calculate the standard deviation of daily returns, which if you realize is the daily volatility of Wipro. Note, in order to use the STDEV function, all you need to do is this. Take the cursor and empty cell. Press equals. Follow the equals sign by the function syntax IESTDEV and open a bracket. Hence the empty cell would look like equals STDEV. After the open bracket, select all the daily return data points and close the bracket. Press enter. Here is the snapshot which shows the same. Once this is done, Excel will instantly calculate the daily standard deviation aka volatility of Wipro for you. I get the answer as 0.0147, which when converted to a percentage reads as 1.47%. This means the daily volatility of Wipro is 1.47%. The value we have calculated is WIPRO's daily volatility. But what about its annual volatility? Now here is a very important convention you will have to remember in order to convert the daily volatility to annual volatility. Just multiply the daily volatility number with the square root of time. Likewise, to convert the annual volatility to daily volatility, divide the annual volatility by square root of time. So in this case we have calculated the daily volatility. And we now need WIPRO's annual volatility. We will calculate the same here. Daily volatility equals 1.47%. Time equals 365. Annual volatility equals 1.47% asterisk SQRT 365 equals 28.08%. In fact, I have calculated the same on Excel. Have a look at the image below. So with this, we know WIPRO's daily volatility is 1.47% and its annual volatility is about 28%. Let's double check these numbers with what the NSE has published on their website. NSE publishes these numbers only for F&O stocks and not other stocks. Here is the snapshot of the same. Our calculation is pretty much close to what NSE has calculated. As per NSE's calculation, Wipro's daily volatility is about 1.34% and annualized volatility is about 25.5%. So why is there a slight difference between our calculation and NSE's? One possible reason could be that we are using spot price while NSE is using futures price. However, I really don't want to get into investigating why this slight difference exists. The agenda here is to know how to calculate the volatility of the security given its daily returns. Before we wrap up this chapter, let us just do one more calculation. Assume we directly get the annual volatility of Wipro as 25.5%. How do we figure out its daily volatility? Like I mentioned earlier, to convert annual volatility to daily volatility, you simply have to divide the annual volatility by the square root of time. Hence, in this particular case, equals 25.5% SQRT 365 equals 1.34%. So far we have understood what volatility is and how to calculate the same. In the next chapter we will understand the practical application of volatility. Do remember, we are still in the process of understanding volatility. However, the final objective is to understand the option Greek vega, and that really means. So please do not lose sight of our end objective. Please click here to download the Excel sheet. Key takeaways from this chapter. Standard deviation represents volatility, which in turn represents risk. We can use NSE website to get the daily closing prices of securities. Daily return can be calculated as log returns. Log function in Excel as lane. Daily return formula equals lane, today's value, yesterday's value, expressed as a percentage. Excel function to calculate volatility is STDEV. Standard deviation of daily return is equivalent of daily volatility. To convert daily volatility to annual volatility, multiply the daily volatility by the square root of time. Likewise, to convert annual volatility to daily volatility, divide the annual volatility by the square root of time. 180. Open a ZERODHA account. Chapter 17. Volatility and Normal Distribution. Hindi Gujarati. 17.1 Background. In the earlier chapter we had this discussion about the range within which Nifty is likely to trade, given that we know its annualized volatility. We arrived at an upper and lower end range for Nifty and even concluded that Nifty is likely to trade within the calculated range. Fair enough. But how sure are we about this? Is there a possibility that Nifty would trade outside this range? If yes, what is the probability that it will trade outside the range, and what is the probability that Nifty will trade within the range? If there is an outside range, then what are its values? Finding answers to these questions are very important for several reasons. If not for anything, it will lay down a very basic foundation to a quantitative approach to markets, which is very different from the regular fundamental and technical analysis thought process. So let us dig a bit deeper and get our answers. 17.2 Random Walk. The discussion we are about to have is extremely important and highly relevant to the topic at hand. And of course very interesting as well. Have a look at the image below. What you see is called Galton board. A Galton board has pins stuck to a board. Collecting bins are placed right below these pins. The idea is to drop a small ball from above the pins. Moment you drop the ball, it encounters the first pin, after which the ball can either turn left or turn right before it encounters another pin. The same procedure repeats until the ball trickles down and falls into one of the bins below. Denote: once you drop the ball from top, you cannot do anything to artificially control the path that the ball takes before it finally rests in one of the bins. The path that the ball takes is completely natural and is not predefined or controlled. For this particular reason, the path that the ball takes is called the random walk. Now, can you imagine what would happen if you were to drop several such balls one after the other? Obviously, each ball will take a random walk before it falls into one of the bins. However, what do you think about the distribution of these balls in the bins? Will they all fall in the same bin? Or will they all get distributed equally across the bins? Or will they randomly fall across the various bins? I'm sure people not familiar with this experiment would be tempted to think that the balls would fall randomly across various bins and does not really follow any particular pattern. But this does not happen. There seems to be an order here. Have a look at the image below. It appears that when you drop several balls on the Galton board, with each ball taking a random walk, they all get distributed in a particular way. Most of the balls tend to fall in the central bin. As you move further away from the central bin, either to the left or right, there are fewer balls. The bins at extreme ends have very few balls. A distribution of this sort is called the normal distribution. You may have heard of the bell curve from your school days. Bell curve is nothing but the normal distribution. Now here is the best part. Irrespective of how many times you repeat this experiment, the balls always get distributed to form a normal distribution. This is a very popular experiment called the Galton board experiment. I would strongly recommend you to watch this beautiful video to understand this discussion better. So why do you think we are discussing the Galton board experiment and the normal distribution? Well, many things in real life follow this natural order. For example, gather a bunch of adults and measure their weights. Segregate the weights across bins. Call them the weight bins, like 40 kgs to 50 kgs, 50 kgs to 60 kgs, 60 kgs to 70 kgs, etc. Count the number of people across each bin and you end up getting a normal distribution. Conduct the same experiment with people's height and you will end up getting a normal distribution. You will get a normal distribution with people's shoe size, weight of fruits, vegetables, commute time on a given route, lifetime of batteries. This list can go on and on. However, I would like to draw your attention to one more interesting variable that follows the normal distribution: the daily returns of a stock. The daily returns of a stock or an index cannot be predicted, meaning if you were to ask me what will be returned on TCS tomorrow, I will not be able to tell you. This is more like the random walk that the ball takes. However, if I collect the daily returns of the stock for a certain period and see the distribution of these returns, I get to see a normal distribution, aka the bell curve. To drive this point across, I have plotted the distribution of the daily returns of the following stocks, indices: Nifty Index, Bank Nifty Index, TCS large cap, Cipla large cap, Keytex garments small cap, Astral Poly small cap. As you can see, the daily returns of the stocks and indices clearly follow a normal distribution. Fair enough. But I guess by now you would be curious to know why is this important and how is it connected to volatility? Bear with me for a little longer and you will know why I'm talking about this. 17.3 Normal distribution. I think the following to discussion could be a bit overwhelming for a person exploring the concept of normal distribution for the first time. So here is what I will do. I will explain the concept of normal distribution. Relate this concept to the Galton board experiment, and then extrapolate it to the stock markets. I hope this will help you grasp the gist better. So besides the normal distribution, there are other distributions across which data can be distributed. Different datasets are distributed in different statistical ways. Some of the other data distribution patterns are binomial distribution, uniform distribution, Poisson distribution, chi-square distribution, etc. However, the normal distribution pattern is probably the most well understood and researched distribution amongst the other distributions. The normal distribution has a set of characteristics that helps us develop insights into the dataset. The normal distribution curve can be fully described by two numbers, the distribution's mean, average, and standard deviation. The mean is the central value where maximum values are concentrated. This is the average value of the distribution. For instance, in the Galton board experiment, the mean is that bin which has the maximum numbers of balls in it. So if I were to number the bins, starting from the left as 1, 2, 3, all the way up to 9, rightmost. Then the fifth bin, marked by a red arrow, is the average bin. Keeping the average bin as a reference, the data is spread out on either sides of this average reference value. The way the data is spread out, dispersion as it is called, is quantified by the standard deviation. Recollect, this also happens to be the volatility in the stock market context. Here is something you need to know. When someone says standard deviation, SD, by default they are referring to the first SD. Likewise, there is second standard deviation, 2SD, third standard deviation, SD, etc. So when I say SD, I'm referring to just the standard deviation value. 2SD would refer to 2 times the SD value. 3SD would refer to 3 times the SD value, so on and so forth. For example, assume in case of the Galton board experiment the SD is 1 and average is 5. Then, 1 SD would encompass bins between 4th bin, 5 to 1, and 6th bin, 5 plus 1. This is 1 bin to the left and 1 bin to the right of the average bin. 2 SD would encompass bins between 3rd bin, 5 to 2 asterisk 1, and 7th bin, 5 plus 2 asterisk 1. 3 SD would encompass bins between 2nd bin, 5 to 3 asterisk 1, and 8th bin, 5 plus 3 asterisk 1. Now keeping the above in perspective, here is the general theory around the normal distribution which you should know. Within the first standard deviation, one can observe 68% of the data. Within the second standard deviation, one can observe 95% of the data. Within the third standard deviation, one can observe 99.7% of the data. The following image should help you visualize the above. Applying this to the Galton board experiment. Within the first standard deviation, i.e. between 4th and 6th bin, we can observe that 68% of balls are collected. Within the second standard deviation, i.e. between 3rd and 7th bin, we can observe that 95% of balls are collected. Within the third standard deviation, i.e. between 2nd and 8th bin, we can observe that 99.7% of balls are collected. Keeping the above in perspective, let us assume you are about to drop a ball on the Galton board, and before doing so we both engage in a conversation. I'm about to drop a ball. Can you guess which bin the ball will fall into? Me, no. I cannot, as each ball takes a random walk. However, I can predict the range of bins in which it may fall. Can you predict the range? Me, most probably the ball will fall between the 4th and the 6th bin. Well, how sure are you about this? Me, I'm 68% confident that it would fall anywhere between the 4th and the 6th bin. Well, 68% is a bit low on accuracy. Can you estimate the range with a greater accuracy? Me, sure. I can. The ball is likely to fall between the 3rd and 7th bin. And I'm 95% sure about this. If you want an even higher accuracy, then I'd say that the ball is likely to fall between the 2nd and 8th bin, and I'm 99.5% sure about this. Nice. Does that mean there is no chance for the ball to fall in either the 1st or 10th bin? Me, well, there is certainly a chance for the ball to fall in one of the bins outside the 3rd SD bins, but the chance is very low. How low? Me, the chance is as low as spotting a black swan in a river. Probability-wise, the chance is less than 0.5%. Tell me more about the black swan. Me, black swan events, as they are called, are events like the ball falling in 1st or 10th bin that have a low probability of occurrence. But one should be aware that black swan events have a non-zero probability, and it can certainly occur when and how is hard to predict. In the picture below you can see the occurrence of a black swan event. In the above picture there are so many balls that are dropped, but only a handful of them collect at the extreme ends. 17.4 Normal distribution in stock returns. Hopefully the above discussion should have given you a quick introduction to the normal distribution. The reason why we are talking about normal distribution is that the daily returns of the stock indices also form a bell curve or a normal distribution. This implies that if we know the mean and standard deviation of the stock return, then we can develop a greater insight into the behavior of the stock's returns or its dispersion. For sake of this discussion, let us take up the case of Nifty and do some analysis. To begin with, here is the distribution of Nifty's daily returns is. As we can see, the daily returns are clearly distributed normally. I've calculated the average and standard deviation for this distribution in case you are wondering how to calculate the same. Please do refer to the previous chapter. Remember, to calculate these values we need to calculate the log daily returns. Daily average mean equals 0.04%. Daily standard deviation volatility equals 1.046%. Current market price of Nifty equals 8,337. Denote. An average of 0.04% indicates that the daily returns of Nifty are centered at 0.04%. Now, keeping this information in perspective, let us calculate the following things. The range within which Nifty is likely to trade in the next 1 year. The range within which Nifty is likely to trade over the next 30 days. For both the above calculations, we will use 1 and 2 standard deviation, meaning with 68% and 95% confidence. Solution 1. Nifty's range for next 1 year. Average equals 0.04%. SD equals 1.046%. Let us convert this to annualized numbers. Average equals 0.04 asterisk 252 equals 9.66%. SD equals 1.046% asterisk SQRT 252 equals 16.61%. So with 68% confidence I can say that the value of Nifty is likely to be in the range of equals average plus 1 SD upper range and average 1 SD lower range equals 9.66% plus 16.61% equals 26.66%. Equals 9.66% to 16.61% equals minus 6.95%. Note these percent are log percentages, as we have calculated this on log daily returns. So we need to convert these back to regular percent. We can do that directly and get the range value, WRT, to Nifty's CMP of 8,337. Upper range equals 8,337 asterisk exponential 26.66% equals 10,841. And for lower range equals 8,337 asterisk exponential minus 6.95% equals 7,777. The above calculation suggests that Nifty is likely to trade somewhere between 7,777 and 10,841. How confident I am about this? Well, as you know, I'm 68% confident about this. Let us increase the confidence level to 95% or the second standard deviation and check what values we get. Average plus 2SD upper range and average 2SD lower range equals 9.66% plus 2 asterisk 16.61% equals 42.87%. Equals 9.66%, 2 asterisk 16.61% equals minus 23.56%. Hence the range works out to upper range equals 8,337 asterisk exponential 42.87% equals 12,800. And for lower range equals 8,337 asterisk exponential minus 23.56% equals 6,587. The above calculation suggests that with 95% confidence Nifty is likely to trade anywhere in the range of 6,587 and 12,800 over the next 1 year. Also, as you can notice, when we want higher accuracy, the range becomes much larger. I would suggest you do the same exercise for 99.7% confidence or with 3SD and figure out what kind of range numbers you get. Now, assume you do the range calculation of Nifty at 3SD level and get the lower range value of Nifty as 5,000. I'm just quoting this as a placeholder number here. Does this mean Nifty cannot go below 5,000? Well, it certainly can, but the chance of going below 5,000 is low. And if it really does go below 5,000, then it can be termed as a black swan event. You can extend the same argument to the upper end range as well. Solution 2. Nifty's range for next 30 days. We know the daily mean and SD. Average equals 0.04%. SD equals 1.046%. Since we are interested in calculating the range for next 30 days, we need to convert the same for the desired time period. Average equals 0.04%, asterisk 30 equals 1.15%. SD equals 1.046%, asterisk SQRT 30 equals 5.73%. So with 68% confidence I can say that the value of Nifty over the next 30 days is likely to be in the range of equals average plus 1 SD upper range and average 1 SD lower range equals 1.15% plus 5.73% equals 6.88%. Equals 1.15% to 5.73% equals 4.58%. Note these percent are log percentages, so we need to convert them back to regular percent. We can do that directly and get the range value WRT to Nifty's CMP of 8,337 equals 8,337 asterisk exponential 6.88%. Equals 8,930. And for lower range equals 8,337 asterisk exponential minus 4.58% equals 7,963. The above calculation suggests that with 68% confidence level one can estimate Nifty to trade somewhere between 8,930 and 7,963 over the next 30 days. Let us increase the confidence level to 95% or the second standard deviation and check what values we get. Average plus 2SD upper range and average 2SD lower range equals 1.15% plus 2 asterisk 5.73% equals 12.61%. Equals 1.15%, 2 asterisk 5.73% equals minus 10.31%. Hence the range works out to equals 8,337 asterisk exponential 12.61% equals 9,457 upper range. And for lower range equals 8,337 asterisk exponential minus 10.31% equals 7,520. I hope the above calculations are clear to you. You can also download the MS Excel that I've used to make these calculations. Of course, you may have a very valid point at this stage. Normal distribution is fine. But how do I get to use the information to trade? I guess as such this chapter is quite long enough to accommodate more concepts. Hence we will move the application part to the next chapter. In the next chapter we will explore the applications of standard deviation, volatility, and its relevance to trading. We will discuss two important topics in the next chapter. 1. How to select strikes that can be sold, written using normal distribution, and 2. How to set up stop loss using volatility. Of course, do remember eventually the idea is to discuss vega and its effect on options premium. Key takeaways from this chapter. The daily returns of the stock is a random walk. Highly difficult to predict. The returns of the stock is normally distributed or rather close to normal distribution. In a normal distribution the data is centered around the mean and the dispersion is measured by the standard deviation. Within 1 SD we can observe 68% of the data. Within 2 SD we can observe 95% of the data. Within 3 SD we can observe 99.5% of the data. Events occurring outside the third standard deviation are referred to as black swan events. Using the SD values we can calculate the upper and lower value of stocks, indices, Open a ZERODHA account. Chapter 18. Volatility Applications. Hindi Gujarati. 18.1 Striking it right. The last couple of chapters have given a basic understanding on volatility, standard deviation, normal distribution, etc. We will now use this information for few practical trading applications. At this stage one would like to discuss two such applications. Selecting the right strike to short, right. Calculating the stop loss for a trade. However, at a much later stage, in a different module altogether, we will explore the applications under a different topic: relative value arbitrage, pair trading, and volatility arbitrage. For now, we will stick to trading options and futures. So let's get started. One of the key challenges an option writer always faces is to select the right strike so that he can write that option, collect the premium, and not really be worried about the possibility of the spot moving against him. Of course, the worry of spot moving against the option writer will always exist. However, a diligent trader can minimize this. Normal distribution helps the trader minimize this worry and increase his confidence while writing options. Let's have a quick recap. The bell curve above suggests that with reference to the mean average value, 68% of the data is clustered around mean within the first SD. In other words, there is a 68% chance that the data lies within the first SD. 95% of the data is clustered around mean within the second SD. In other words, there is a 95% chance that the data lies within the second SD. 99.7% of the data is clustered around mean within the third SD. In other words, there is a 99.7% chance that the data lies within the third SD. Since we know that Nifty's daily returns are normally distributed, the above set of properties is applicable to Nifty. So what does it mean? This means, if we know Nifty's mean and SD, then we can pretty much make an educated guess about the range within which Nifty is likely to trade over the selected time frame. Take this for example. Date equals the 11th of August 2015. Number of days for expiry equals 16. Nifty current market price equals 8,462. Daily average return equals 0.04%. Annualized return equals 14.8%. Daily SD equals 0.89%. Annualized SD equals 17.04%. Given this, I would now like to identify the range within which Nifty will trade until expiry, i.e. 16 days from now. 16-day SD equals daily SD asterisk SQRT 16 equals 0.89% asterisk SQRT 16 equals 3.567%. 16-day average equals daily AVG asterisk 16 equals 0.04% asterisk 16 equals 0.65%. These numbers will help us calculate the upper and lower range within which Nifty is likely to Trade over the next 16 days. Upper range equals 16-day average plus 16-day SD. Equals 0.65% plus 3.567%. Equals 4.215%. To get the upper range number. Equals 8,462 asterisk 1 plus 4.215%. Equals 8,818. Lower range equals 16-day average 16-day SD. Equals 0.65% to 3.567%. Equals 2.920% to get the lower range number. Equals 8,462 asterisk 1 to 2.920%. Equals 8,214. The calculation suggests that Nifty is likely to trade anywhere in the region of 8,214 to 8,818. How sure are we about this? Well, we know that there is a 68% probability for this calculation to work in our favor. In other words, there is 32% chance for Nifty to trade outside 8,214 and 8,818 range. This also means all strikes outside the calculated range may go worthless. Hence, you can sell all call options above 8,818 and collect the premiums because they are likely to expire. Worthless. You can sell all put options below 8,214 and collect the premiums because they are likely to expire. Worthless. Alternatively, if you were thinking of buying call options above 8,818 or put options below 8,214, you may want to think twice, as you now know that there is a very little chance for these options to expire in the money. Hence, it makes sense to avoid buying these strikes. Here is the snapshot of all Nifty call option strikes above 8,818 that you can choose to write short and collect premiums. If I were to personally select a strike today, it would be either 8,850 or 8,900 or probably both and collect 7 rupees and 45 paise and 4 rupees and 85 paise in premium respectively. The reason to select these strikes is simple. I see an acceptable balance between risk 1 SD away and reward 7.45 or 4.85 per lot. I'm certain many of you may have this thought: if I were to write the 8,850 call option and collect 7 rupees and 45 paise as premium, it does not really translate to any meaningful amount. After all, at 7 rupees and 45 paise per lot, it translates to equals 7.45 asterisk 25 lot size equals 186 rupees and 25 paise. Well, this is exactly where many traders miss the plot. I know many who think about the gains or loss in terms of absolute value and not really in terms of return on investment. Think about it. Margin amount required to take this trade is roughly 12,000 rupees per. If you are not sure about the margin requirement, then I would suggest you use Zero as margin calculator. The premium amount of 186 rupees and 25 paise per on a margin deposit of 12,000 rupees per works out to a return of 1.55%. Which by any stretch on imagination is not a bad return, especially for a 16-day holding period. If you can consistently achieve this every month, then we are talking about a return of over 18% annualized just by means of option writing. I personally use this strategy to write options, and I'd like to share some of my thoughts regarding this. Put options. I don't like to short put options for the simple reason that panic spreads faster than greed. If there is panic in the market, the fall in market can be much quicker than you can imagine. Hence, even before you can realize the OTM option that you have written can soon become a TM or ITM. Therefore, it is better to avoid than regret. Call options. You inverse the above point and you will understand why writing call options are better than writing put options. For example, in the Nifty example above, for the 8900 CE to become a TM or ITM, Nifty has to move 438 points over 16 days. For this to happen, there has to be excess greed in the market. And like I said earlier, a 438 up move takes a bit longer than 438 down move. Therefore, my preference to short only call options. Strike identification. I do the whole exercise of identifying the strike SD. Mean calculation. Converting the same WRT to number days to expiry. Selecting appropriate strike only the week before expiry and not before that. The timing here is deliberate. Timing, I prefer to short options only on the last Friday before the expiry week. For example, given the August 2015 series expiry is on 27th, I'd short the call option only on the 21st of August around the closing. Why do I do this? This is to mainly ensure that theta works in my favor. Remember the time decay graph we discussed in the theta chapter? The graph makes it amply evident that theta kicks in full force as we approach expiry. Premium collected, because I write call options very close to expiry. The premiums are invariably low. The premium that I collect is around 5 rupees or 6 on Nifty Index, translating to about 1.0% return. But then I find the trade quite comforting for two reasons. One, for the trade to work against me, Nifty has to move 1 SD over 4 days, something that does not happen frequently. Two, theta works in my favor. The premiums erode much faster during the last week of expiry, favoring the option seller. Why bother? Most of you may have this thought that the premiums are so low. Why should I even bother? Honestly, I too had this thought initially. However, over time I have realized that trades with the following characteristics make sense to me. Visibility on risk and reward. Both should be quantifiable. If a trade is profitable today, then I should be able to replicate the same again tomorrow. Consistency in finding the opportunities. Assessment of worst-case scenarios. This strategy ticks well on all counts above. Hence my preference. SD consideration. When I'm writing options 3 to 4 days before expiry, I prefer to write 1 SD away. However, for whatever reason, when I'm writing the option much earlier, then I prefer to go 2 SD away. Remember, higher the SD consideration, higher is the confidence level, but lower is the premium that you can collect. Also, as a thumb rule, I never write options when there is more than 15 days for expiry. Events. I avoid writing options whenever there are important market events such as monetary policy decision, corporate announcement, etc. This is because the markets tend to react sharply to events and therefore a good chance of getting caught on the wrong side. Hence it is better safe than sorry. Black swan. I'm completely aware that despite all the precaution, markets can move against me and I could get caught on the wrong side. The price you pay for getting caught on the wrong side, especially for this trade, is huge. Imagine you collect 5 or 6 points as premium, but if you are caught on the wrong side, you end up paying 15 or 20 points or more. So all the small profits you made over 9 to 10 months is given away in 1 month. In fact, the legendary Satyajit Das in his highly insightful book Traders, Guns, and Money talks about option writing as eating like a hen but shitting like an elephant. The only way to make sure you minimize the impact of a black swan event is to be completely aware that it can occur anytime after you write the option. So here is my advice to you in case you decide to adopt this strategy. Track the markets and gauge the market sentiment all along. The moment you sense things are going wrong, be quick to exit the trade. Success ratio. Option writing keeps you on the edge of the seat. There are times when you feel that markets are going against you. Fear of black swan creeps in, but only to cool off eventually. When you write options, such roller coaster feelings are bound to emerge. The worst part is that during this roller coaster ride, you may be forced to believe that the market is going against you. False signal, and hence you get out of a potentially profitable trade. In fact, there is a very thin line between a false signal and an actual black swan event. The way to overcome this is by developing conviction in your trades. Unfortunately, I cannot teach you conviction. You will have to develop that on your own, Jay. However, your conviction improves as and when you do more of these trades, and all trades should be backed by sound reasoning and not blind guesses. Also, I personally get out of the trade when the option transitions from OTM to ATM. Expenses. The key to these trades is to keep your expense to bare minimum so that you can retain maximum profits for yourself. The expenses include brokerage and applicable charges. If you short one lot of nifty options and collect 7 rupees as premium, then you will have to let go few points as expense. If you are trading with Zerodha, your expense will be around 1.95 for one lot. The higher the number of lots, the lesser is your expense. So if I were trading 10 lots with Zerodha instead of 1, my expense drastically comes down to 0.3 points. You can use Zerodha's brokerage calculator to get the details. The cost varies broker to broker, so please do make sure your broker is not greedy by charging you ridiculous brokerage fees. Even better, if you are not with Zerodha, it is about time you join us and become a part of our beautiful family. Smiley face. Capital allocation, an obvious question you might have at this stage. How much money do I deploy to this trade? Do I risk all my capital or only a certain percent? If it's a percent, then how much would it be? There is no straightforward answer to this. Hence, I'll take this opportunity to share my asset allocation technique. I'm a complete believer in equities as an asset class. So this rules out investment in gold, fixed deposit, and real estate for me. 100% of my capital savings is invested in equity and equity-based products. However, it is advisable for any individual to diversify capital across multiple asset classes. So within equity, here is how I have split my money. 35% of my money is invested in equity-based mutual funds, SIP, Systematic Investment Plan, ROOT. I have further divided this across 4 funds. 40% of my capital in an equity portfolio of about 12 stocks. I consider both mutual funds and equity portfolio as long-term investments, 5 years and beyond. 25% is earmarked for short-term strategies. The short-term strategies include a bunch of trading strategies such as momentum-based swing trades, futures, overnight futures, options, stock trades, intraday trades, option writing. I make sure that I do not expose more than 35% of the 25% capital for any particular strategy. Just to make it more clear, assume I have 500,000 rupees per as my capital. Here is how I would split my money. 35% of 500,000 rupees per, i.e. 175,000 rupees per, goes to mutual funds. 40% of 500,000 rupees per, i.e. 200,000 rupees per, goes to equity portfolio. 25% of 500,000 rupees per, i.e. 125,000 rupees per, goes to short-term trading. 35% of 125,000 rupees per, i.e. 43,750 rupees per, is the maximum I would allocate per trade. Hence, I will not short more than 4 lots of options. 43,750 is about 8.75% of the overall capital of 500,000 rupees per. So this self-mandated rule ensures that I do not expose more than 9% of my overall capital to any particular short-term strategies, including option writing instruments. I prefer running this strategy on liquid stocks and indices. Besides Nifty and Bank Nifty, I run this strategy on SBI, Infosys, Reliance, Tata Steel, Tata Motors, and TCS. I rarely venture outside this list. So here is what I would suggest you do. Run the exercise of calculating the SD and mean for Nifty. Bank Nifty on the morning of August 21st, 5 to 7 days before expiry. Identify strikes that are 1 SD away from the market price and write them virtually. Wait till the expiry and experience how this trade goes. If you have the bandwidth, you can run this across all the stocks that I've mentioned. Do this diligently for few expiries before you can deploy capital. Lastly, as a standard disclaimer, I have to mention this: the thoughts expressed above suits my risk-reward temperament, which could be very different from yours. Everything that I mentioned here comes from my own personal trading experience. These are not standard practices. I would suggest you note these points. Understand your own risk-reward temperament and calibrate your strategy. Hopefully the pointers here should help you develop that orientation. This is quite contradicting to this chapter, but I have to recommend you to read Nassim Nicholas' Talibas, Fooled by Randomness. At this point, the book makes you question and rethink everything that you do in markets and life in general. I think just being completely aware of what Talib writes in his book, along with the actions you take in markets, puts you in a completely different orbit. 18.2 Volatility-based stop loss. The discussion here is a digression from options. In fact, this would have been more apt in the futures trading module. But I think we are at the right stage to discuss this topic. The first thing you need to identify before you initiate any trade is to identify the stop loss. SL, price for the trade. As you know, the SL is a price point beyond which you will not take any further losses. For example, if you buy Nifty futures at 8,300, you may identify 8,200 as your stop loss level. You will be risking 100 points on this particular trade. The moment Nifty falls below 8,200, you exit the trade, taking the loss. The question, however, is how to identify the appropriate stop loss level. One standard approach used by many traders is to keep a standard prefixed percentage stop loss. For example, one could have a 2% stop loss on every trade. So if you were to buy a stock at 500 rupees, then your stop loss price is 490 rupees and you risk 10 rupees, 2% of 500 rupees, on this trade. The problem with this approach lies in the rigidity of the practice. It does not account for the daily noise, volatility of the stock. For example, the nature of the stock could be such that it could swing about 2 to 3% on a daily basis. As a result, you could be right about the direction of the trade but could still hit a stop loss. More often than not, you would regret keeping such tight stops. An alternate and effective method to identify a stop loss price is by estimating the stock's volatility. Volatility accounts for the daily, expected, fluctuation in the stock price. The advantage with this approach is that the daily noise of the stock is factored in. Volatility stop is strategic as it allows us to place a stop at the price point which is outside the normal expected volatility of the stock. Therefore, a volatility SL gives us the required logical exit in case the trade goes against us. Let's understand the implementation of the volatility-based SL with an example. This is the chart of Airtel forming a bullish harami. People familiar with the pattern would immediately recognize this is an opportunity to go long on the stock, keeping the low of the previous day also coinciding with a support as the stop loss. The target would be the immediate resistance. Both S and R points are marked with a blue line. Assume you expect the trade to materialize over the next 5 trading sessions. The trade details are as follows. Long at 395. Stop loss at 385. Target at 417. Risk equals 395 to 385 equals 10 or about 2.5% below entry price. Reward equals 417 to 385 equals 32 or about 8.1% above entry price. Reward to risk ratio equals 32/10 equals 3.2, meaning for every 1 point risk, the expected reward is 3.2 point. This sounds like a good trade from a risk to reward perspective. In fact, I personally consider any short-term trade that has a reward to risk ratio of 1.5 as a good trade. However, everything hinges upon the fact that the stop loss of 385 is sensible. Let us make some calculations and dig a little deeper to figure out if this makes sense. Step 1. Estimate the daily volatility of Airtel. I've done the math and the daily volatility works out to 1.8%. Step 2. Convert the daily volatility into the volatility of the time period we are interested in. To do this, we multiply the daily volatility by the square root of time. In our example, our expected holding period is 5 days. Hence the 5-day volatility is equal to 1.8% asterisk SQRT 5. This works out to be about 4.01%. Step 3. Calculate the stop-loss price by subtracting 4.01% 5-day volatility from the expected entry price. 395 4.01% of 395 equals 379. The calculation above indicates that Airtel can swing from 395 to 379 very easily over the next 5 days. This also means a stop loss of 385 can be easily knocked down. So the SL for this trade has be a price point below 379. Let's say 375, which is 20 points below the entry price of 395. Step 4. With the new SL, the RRR works out to 1.632/20, which still seems okay to me. Hence I would be happy to initiate the trade. Note: in case our expected holding period is 10 days, then the 10-day volatility would be 1.6 asterisk SQRT 10, so on and so forth. Prefix percentage stop loss does not factor in the daily fluctuation of the stock prices. There is a very good chance that the trader places a premature stop loss well within the noise levels of the stock. This invariably leads to triggering the stop loss first and then the target. Volatility-based stop loss takes into account all the daily expected fluctuation in the stock prices. Hence, if we use a stock's volatility to place our stop loss, then we would be factoring in the noise component and in turn placing a more relevant stop loss. Key takeaways from this chapter. You can use SD to identify strikes that you can write. Avoid shorting put options. Strikes 1 SD away offers 68% flexibility. If you need higher flexibility, you could opt for 2 SD. Higher the SD, higher is the range, and lower is the premium collected. Allocate capital based on your belief in asset classes. It is always advisable to invest across asset classes. It always makes sense to place SL based on daily volatility of the stock.